Nobody tells you the moment that changes everything feels exactly like every other moment. You wake up, you check your phone, you scroll through the same noise you always scroll through, and somewhere buried between a meme and a news alert is a number, a price, and your brain doesn't register it as important because your brain wasn't trained to recognize what a historic bottom looks like in real time. It only recognizes it later, years later, when that number is 4 times higher and you're sitting across from someone at dinner and they mention offhand that they bought silver back when it was cheap, and you feel that specific, quiet, devastating feeling of having been right there, right at the moment, and having walked past it like it was nothing. That feeling is what I'm trying to save you from today, because I have been studying this market for a long time. I have watched the data accumulate. I have watched the fundamentals build on top of each other like pressure building beneath a fault line. And I am telling you with everything I have, the bottom is in, the window is closing, and what you do in the next few weeks and months is going to matter for the next decade of your financial life in ways that are genuinely hard to overstate. So stay with me. Turn off the other noise. Give this your full attention, because I'm going to walk you through every single layer of this story: the industrial case, the monetary case, the supply crisis, the demand explosion, the manipulation, the paper market, the physical market, the ratio, the history, the math, and the psychology. And by the time we're done, you're not going to need me to tell you what to do, because the evidence is going to tell you itself, and the evidence right now is screaming. Let's start with the thing that most people get completely wrong about silver, which is what silver actually is. Because if you think silver is just a cheaper version of gold, a consolation prize for people who can't afford the real thing, then you are missing the most important part of the story, and you are going to miss the trade because of it. Silver is not gold's little cousin. Silver is the most industrially useful element on the periodic table. That is not a marketing line, that is a chemistry fact. Silver has the highest electrical conductivity of any metal on Earth. It has the highest thermal conductivity of any metal on Earth. It has natural antibacterial and antimicrobial properties that no synthetic material has been able to fully replicate. It reflects light more efficiently than any other element. And because of this extraordinary combination of properties, silver is not just sitting in vaults and jewelry boxes waiting for monetary anxiety to spike. It is being consumed right now, every single day, in quantities that the world has never seen before, in industries that are growing faster than almost any other sector of the global economy. The solar industry alone has transformed the demand picture for silver in a way that even the most bullish analysts 5 years ago did not fully anticipate. Every photovoltaic solar panel that gets manufactured, every single one, requires silver. The silver is in the conductive paste that is printed onto the silicon cells. It is what makes the electricity actually move, and you cannot substitute it out without losing efficiency, and efficiency is the entire game in solar economics. The Silver Institute, which tracks this data with more precision than anyone, has documented that solar demand for silver has more than doubled in just the last few years. More than doubled. And the global solar build-out is not slowing down, it is accelerating, because governments around the world have made legally binding commitments to renewable energy targets that require solar capacity to expand by multiples of its current size over the next 10 to 15 years. Europe is doing it, the United States is doing it, China is doing it at a scale that is almost incomprehensible, India is doing it, and every panel in every one of those installations requires silver, and that silver, once it is in the panel, is gone. It is not recyclable in any economically meaningful sense at current technology levels. It is consumed. It is a one-way door. It goes into the panel, and it does not come back into the market. And then you have electric vehicles, which are doing to silver demand what nobody in the traditional precious metals community was talking about 5 years ago. Every electric vehicle contains silver in the wiring harnesses, in the battery management systems, in the thermal management systems, in the charging infrastructure, in the power electronics that convert and regulate the flow of electricity throughout the vehicle. As the global fleet transitions from internal combustion to electric, the silver demand from that single sector is going to add a demand pressure that the market has never experienced before. The projections from credible automotive and materials research firms suggest that EV-related silver demand could add tens of millions of additional ounces of annual demand to a market that is already in structural deficit. And we are still in the early innings of the EV transition. The curve is just starting to bend upward in a serious way. The countries that are going to matter most, China, Europe, the United States, are all accelerating their transition timelines, not slowing them down. Then there is 5G infrastructure, which is another demand driver that most silver investors don't talk about enough. The deployment of 5G networks globally requires an enormous amount of silver in the antennas, in the base stations, in the connected devices that will ultimately populate the 5G ecosystem. And the 5G rollout is global, and it is happening over a decade-long timeline, which means sustained, consistent, growing demand from that sector for years to come. Then there is defense spending, which is rising globally for reasons that everyone understands and that are not going away anytime soon, and modern defense technology, from guided munitions to radar systems to advanced avionics, is silver intensive in ways that are not publicly disclosed in detail, but that procurement experts who track these things understand well. Then there is medical technology, where silver's antimicrobial properties make it genuinely irreplaceable in wound care products, in certain medical devices, in water purification systems in both hospitals and in the developing world. Then there is the broader electronics industry. Every circuit board, every switch, every contact in the consumer electronics that 4 billion people on this planet use every day has silver in it. The phone you're holding right now has silver in it. The laptop, the tablet, the television, silver, silver, silver. And all of that demand is structural. It is not speculative. It is not driven by fear or sentiment or narrative. It is driven by the physical requirements of technologies that are embedded in the way the modern world operates and that are going to become more embedded, not less, as the years go on. Now, flip to the supply side, and this is where the story gets really important, because most people assume that if silver demand goes up, the mining industry will simply respond by producing more silver. That is not how this works, and understanding why it doesn't work that way is central to understanding why the price has no choice but to go higher. The majority of global silver supply, roughly 70 to 75% depending on the year, does not come from primary silver mines. It comes as a byproduct of mining other metals. When you mine copper, you get some silver. When you mine zinc, you get some silver. When you mine lead, you get some silver. Even gold mining produces some silver. Silver is a secondary product of these operations, which means that the decision about how much silver to produce is not made based on silver economics. It is made based on copper economics, zinc economics, lead economics, gold economics. If copper demand falls and copper miners cut production, global silver supply falls too, even if silver demand is strong and silver prices are rising. The supply response mechanism that exists for most commodities, higher prices lead to more production, is fundamentally broken for silver, because most of the production is controlled by forces that have nothing to do with the silver market. The primary silver mining industry, the mines that are actually going after silver intentionally, is relatively small, and it is not capable of meaningfully offsetting the supply constraints that come from the byproduct nature of most global silver production. And bringing new primary silver mines online is not a quick process. From initial geological discovery to first production typically takes between 7 and 12 years, depending on jurisdiction, environmental permitting, infrastructure requirements, and a dozen other variables. You cannot respond to a silver supply shortage that exists today with new mines that won't produce for a decade. And the grades of ore being processed at existing silver mines are declining, which means that even holding production volumes constant requires more energy, more water, more equipment, more labor, and when ore grades fall, costs rise and margins compress. The economics of silver mining are difficult, and the supply picture reflects that difficulty. The Silver Institute's data on this is unambiguous. For the last several consecutive years, the global silver market has been in a physical supply deficit. The world is using more silver than it is mining. Full stop. The gap has been filled by drawing down above-ground inventories, the stockpiles that were built up over many decades. But those stockpiles are finite. They are being reduced every year. And at some point, and based on the trajectory, that point is not far away, the market will not be able to cover the deficit with inventory drawdowns, and the price will have to rise enough to either destroy demand or incentivize enough new supply to rebalance the market. Given that the demand is driven by energy transition and technology, sectors that are subsidized, mandated, and structurally growing, destroying demand is going to be very difficult, which means the price signal is going to have to do a lot of heavy lifting on the supply side. And for the price signal to incentivize meaningful new supply in a market where supply response takes a decade, the price needs to go somewhere that makes new mining economically attractive at a level that gets capital flowing into exploration and development today for production that will come years from now. That level is not where silver is today. It is significantly higher, Now I want to spend real time on the monetary case because this is where I think the biggest misunderstanding lies, and getting this right is important for understanding why the timing right now is particularly significant. We are living through a monetary moment that has no real parallel in modern history. The scale of currency creation that has occurred over the last 15 years, and specifically over the period from 2020 to the present, is genuinely unprecedented. The Federal Reserve expanded its balance sheet from under $1 trillion before the 2008 financial crisis to over $8 trillion at its peak. The money supply, measured by M2, expanded at rates during the COVID period that were multiples of anything seen in the post-war era. This was not a one-time emergency measure that was then fully reversed. The balance sheet has come down somewhat from its peak, but it remains at levels that would have been considered extraordinary just 15 years ago. And the structural dynamics that created the conditions for this monetary expansion have not been resolved, they have deepened. Sovereign debt levels globally are at historic highs. The United States government is running fiscal deficits that are structural, not cyclical, meaning they persist even in periods of economic growth and low unemployment, which is a fundamentally different situation from the deficits of previous eras that expanded in recessions and contracted in recoveries. The interest on the national debt has become one of the largest line items in the federal budget. The Congressional Budget Office projects that this dynamic will continue and worsen over the coming decade under current policy. The ability of the Federal Reserve to raise interest rates high enough to genuinely suppress inflation is constrained by this debt burden in a way that monetary economists have long warned about, because every percentage point of higher rates means hundreds of billions of additional dollars of annual interest expense that the federal government has to finance, which it finances by borrowing more, which increases the debt, which increases the interest expense in a cycle that has no clean exit. This is the fiscal monetary trap. We are in it, and the implications of being in it are significant for anyone who holds their savings in dollar-denominated assets. In this environment, assets that cannot be printed, cannot be digitally created, cannot be expanded by a committee decision, assets that exist in fixed, physically constrained quantities and that have intrinsic utility, become extremely important stores of value. Gold has recognized this before silver has in the current cycle, and gold has been rewarded with new all-time highs and significant mainstream attention. But silver's monetary history is just as deep as gold's. Throughout thousands of years of human civilization, silver and gold have been the co-anchors of monetary systems. Silver has been money longer than any fiat currency in history has existed. The Roman denarius was silver. The British pound was originally a pound weight of sterling silver. The Spanish pieces of 8 that financed global trade for centuries were silver. American dimes and quarters were silver until 1964. Silver has been money everywhere that humans have organized economies throughout recorded history, and its demonetization in the 20th century was a relatively recent and historically unusual development. When the monetary narrative reasserts itself, and in environments of currency debasement, it always does, silver does not just participate in the monetary trade. It explodes in it because it starts from a lower base than gold, and because the market is small enough that flows that would be relatively modest in the gold market are enormous in the silver market. The math of silver's market size versus the amount of capital that could potentially reallocate into it is one of the most compelling asymmetric arguments in finance. The total above ground investment silver in the world is worth, at current prices, a fraction of a single large technology company's market capitalization. If institutional allocators around the world shift even a small percentage of their portfolios towards silver, not a large percentage, a small one, the demand shock to a market that is already in structural deficit would be extraordinary. The gold-to-silver ratio is the cleanest single metric for understanding where silver is in its historical valuation cycle relative to gold. Right now, that ratio is at levels that have historically represented extreme undervaluation of silver relative to gold. To explain what this means, the ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is relatively cheap compared to gold. When it is low, silver is relatively expensive. The historical average of this ratio across centuries of monetary history has been somewhere between 15 and 20 to 1. The geological ratio, how much silver exists in the Earth's crust relative to gold, is approximately the same, around 15 to 1. Right now, the market is pricing silver as though it is 50, 60, or more times less valuable than gold. Every single time in documented modern financial history that this ratio has stretched to extreme levels, it has subsequently compressed back toward historical norms. Not gradually, violently. Silver has always snapped back harder and faster than gold in these corrections. In the 2008 to 2011 cycle, when the ratio went from roughly 80 at the depth of the financial crisis to around 35 at the peak of the silver move, someone who understood this and rotated from gold to silver at the right moment made 3 to 4 times more than someone who simply held gold. The ratio is sitting at extended levels right now. The rubber band is stretched, and it will snap back, as it always has, because the forces that stretch it, primarily the paper futures market and its ability to temporarily suppress silver's price relative to gold, are not infinitely powerful. The physical market eventually asserts itself. It always does. Let me address the manipulation issue directly and seriously, because I think it deserves more than a passing mention. In 2020, JP Chase, one of the largest financial institutions in the world, entered into a deferred prosecution agreement with the United States Department of Justice and paid approximately $900 million in fines and disgorgement related to the manipulation of the precious metals futures markets, including silver. Their traders, over a period of approximately 8 years, engaged in a practice called spoofing, placing large orders in the futures market with the intention of moving prices, then canceling those orders before they could be filled. This practice created artificial price signals that other market participants traded on the basis of, which is exactly why it is illegal under the Commodity Exchange Act and why it constitutes wire fraud under federal law. This is not a conspiracy theory. It is a documented fact established by a federal legal proceeding involving one of the most sophisticated financial institutions in the world. The question that this settlement raises, which the DOJ proceeding did not fully address, is what the natural, unmanipulated price of silver would be if the futures market had not been used as a tool for price suppression over an extended period. There is no clean answer to that question, but the fact that the manipulation occurred at scale over years by the largest participant in the silver futures market is relevant to any analysis of silver's current price and its relationship to fundamental value. It is also relevant to the current moment because the environment of oversight and enforcement around the futures market has changed as a result of these proceedings, and the ability of large institutions to run the same playbook that JP Morgan ran is constrained in ways it was not constrained a decade ago. The suppression mechanism is less powerful. The physical market is increasingly asserting its own price discovery in ways that diverge from the paper price, as evidenced by the elevated premiums on physical silver products that have persisted through multiple market cycles in recent years. The 2020 and 2021 experience in silver provides a really important preview of what a full-scale silver move looks like, and studying it carefully is instructive. In the spring of 2020, at the depth of the COVID panic, silver fell to around $12 an ounce, one of the lowest levels in years, and then it moved. By the summer of 2020, it was at $30. That is a 150% move in approximately 4 months in a market that most mainstream investors were not paying any attention to. And then in early 2021, the Wall Street Bets community, the retail trading phenomenon that had just executed the GameStop short squeeze, briefly turned its collective attention to silver. For a period of days, the physical silver market was genuinely overwhelmed. Dealers sold out. Premiums on Silver Eagle coins, which in normal markets run a few dollars above spot, spiked to levels that hadn't been seen in years. The US Mint announced allocation constraints. Online dealers had wait lists. This happened with a fraction of the capital and coordination that would be involved in a real institutional move into silver. The retail frenzy was brief and ultimately contained, but it demonstrated something important. The physical silver market is extremely sensitive to demand shocks because the float of readily available physical silver is much smaller than most people assume. When real buying pressure shows up, the market cannot absorb it without moving price significantly. Now imagine that dynamic knot with a retail trading community that gets bored and moves on after a few days, but with sovereign wealth funds, pension funds, family offices, and institutional allocators making long-term strategic decisions to add precious metals exposure in an environment of monetary instability. The move that a sustained institutional allocation to silver would produce in a market this small and this supply constrained is not comparable to what happened in 2021. It would be in a completely different category. I want to talk about what the smartest money in the world is actually doing right now, because actions matter more than words in finance, and the actions of sophisticated long horizon capital are telling a very clear story. Central banks globally have been purchasing gold at the fastest pace in decades. This is documented and publicly reported. The countries doing the most buying, China, Russia, India, Poland, Turkey, and others, are not buying gold because they think it is going to have a good quarter. They are buying it as a strategic reserve asset, as a store of value outside the dollar system, as a hedge against the monetary instability that they can see building in the global financial system. Central banks understand monetary systems better than anyone. They are the monetary system, and they are buying hard assets in size. Silver is not a central bank reserve asset in the way that gold is, but silver moves in sympathy with gold in monetary environments, and the rotation into hard assets that central bank gold buying represents is a leading indicator of where the investment narrative is heading. Family offices, the private investment offices of the world's wealthiest families, who typically have the longest time horizons and the most sophisticated risk management frameworks of any investor class, have been quietly increasing precious metals allocations, not announcing it, not writing white papers about it, just buying. And the voices in mainstream finance, who spent the last decade dismissing gold and silver as barbarous relics paying no dividend and having no place in a modern portfolio, are getting quieter. Some of them are reversing. The consensus is shifting slowly and then all at once, as it always does. Now I want to talk about the psychology of this trade, because I think it is as important as the fundamentals, and it is something that most financial analysis completely ignores. The reason most people miss generational investment opportunities is not because they lack access to information. In the age of the internet, information is essentially free and universally accessible. The reason most people miss these opportunities is psychological. It is the way human beings process information and make decisions under conditions of uncertainty and social pressure. When silver is unpopular, when it is ignored by mainstream media, dismissed by mainstream finance, not discussed at dinner parties, not trending on social media, it feels risky to buy it. Even if the fundamentals are compelling, even if the data is unambiguous. The social signal is negative, and human beings are wired to follow social signals because for most of evolutionary history, doing what the group was doing was the survival strategy. The assets that have the strongest fundamental cases at any given moment are almost always the ones that feel the most uncomfortable to own, because if they felt comfortable, they would already be priced accordingly. The discomfort is the signal. The dismissal is the opportunity. When silver was $12 in March of 2020, it felt dangerous to buy it. The world was ending. The economy was collapsing. Cash felt like the only safe thing. But $12 was the bottom, and the people who bought through their fear made 150% in 4 months. The people who waited for certainty, who waited for the all-clear signal, who waited until silver felt safe, they bought at 20, 5 or 30, and didn't experience anything like that return. This is how markets work. The entry point that produces extraordinary returns is always the one that feels most uncertain. If it felt certain, everyone would do it, and the opportunity would be gone. Right now, buying silver below $80 feels uncertain. There are legitimate questions about timing. There are legitimate questions about short-term price volatility. There are legitimate arguments that the move might take longer than anyone expects. These uncertainties are real. I am not asking you to pretend they don't exist. What I am asking you to do is weigh them against the fundamental case, the supply deficit, the industrial demand explosion, the monetary environment, the gold to silver ratio, the constrained supply response mechanism, the physical market dynamics, the breakdown of the manipulation infrastructure, and ask yourself honestly whether the risk of not being positioned outweighs the risk of short-term volatility in the process of getting positioned. Because the asymmetry here is extraordinary. The downside scenario, silver goes sideways or lower for another year or two before the move happens, is inconvenient and requires patience. The upside scenario, silver moves from below 80 to 150, $200, $250 as the fundamental case asserts itself, is financially transformational. When the risk-reward asymmetry looks like this, the rational response is not to wait for more certainty. The rational response is to size the position appropriately and be early rather than late. Let me be concrete about what appropriate positioning looks like, because I think vagueness here is a disservice. Most serious investors and analysts who think carefully about portfolio construction suggest precious metals allocations in the range of 5 to 15% of investable assets, with the exact percentage depending on individual circumstances, risk tolerance, time horizon, existing portfolio composition, and personal financial situation. This is not a trade where you liquidate your retirement account and go all in. This is a strategic allocation to an asset class that has compelling fundamental characteristics in the current environment, sized appropriately relative to your total financial picture. Within that allocation, there are different ways to express the silver thesis with different risk and return profiles. Physical silver, an actual metal in your possession, provides the purest exposure with no counterparty risk. You own the metal, full stop. Nothing in the financial system has to function correctly for your position to retain value. The costs are the premiums you pay above spot, and the storage and insurance costs, and the illiquidity relative to paper assets. Silver ETFs, particularly the Sprott Physical Silver Trust, give you liquid, tradable exposure with the comfort of allocated physical backing and the ability for large holders to redeem for physical metal. Silver mining equities give you leveraged exposure to the silver price because mining company profitability is highly sensitive to the silver price, and small moves in silver translate to large moves in well-run miners, but they come with company-specific risks that require research and judgment. Silver royalty and streaming companies sit in a middle ground with attractive business model characteristics. A thoughtful silver position might combine elements of all of these, weighted based on your own assessment of the risk-reward trade-offs at each level of the capital structure. None of this is financial advice. These are frameworks for thinking about the trade, not recommendations for your specific situation. Please do your own research and consult a qualified financial professional before making any investment decisions. Here is what I know about inflection points. They never announce themselves. They don't come with a signal that everyone can see simultaneously and respond to simultaneously. If they did, they wouldn't be inflection points. They would just be consensus price discovery. The inflection points that change people's financial lives are the ones that are visible only to the people who have done the work, who have looked at the data, who have understood the fundamentals, and who have had the conviction to act before the mainstream narrative catches up to reality. The people who bought gold at $250 in 2001 were not heroes of mainstream financial opinion. They were contrarians. They were doing what seemed irrational to most of the people around them. And they were right in a way that played out over a decade and produced returns that mainstream finance did not come close to matching over the same period. The people who understood the silver setup in 2020 and bought at $12 were not celebrated at the time. They were buying into a market that was falling during a global panic. And they were right in a way that produced 150% in 4 months. The pattern is the same every time. The opportunity is largest when the narrative is most negative and the mainstream is most dismissive. Right now, silver below $80 is not generating breathless mainstream coverage. It is not being discussed seriously on the financial channels that most people watch. It is not a dinner party conversation. The people who understand it are the ones who have done the work, and they are quietly positioning. The mainstream will catch up. It always does. But by the time it does, the entry point that exists today will be a memory, and the people who are buying now will be the ones that everyone else wishes they had listened to. I am not able to tell you exactly when the move happens. Nobody can. Markets do not operate on predictable timelines. What I can tell you is that the fundamental case is as strong as it has been in a very long time. The supply-demand math is as compelling as it has ever been. The monetary environment is supportive in ways that are historically associated with large moves in precious metals. And the entry price relative to where this asset will be in 5 years is going to look extraordinary in hindsight. The window below $80 will close. Not because of hype, not because of social media momentum, because the math will force it closed. And when it closes, it will close fast. Be on the right side of that window. Do the research, understand what you own, size the position appropriately, and be early. Because early in this market, at this moment, with this setup, is the only way to capture what is coming. I'll see you in the next one.